putting virtual currency under control? The world's number one virtual currency Bitcoin has lost more than 50% of its value since its peak in November last year, plus the collapse of the Terra/Luna stablecoin ecosystem, which wiped out $45 billion of investors this May, caused a wave of criticism of cryptocurrencies to increase. At the World Economic Forum in Davos, Switzerland, many leaders of global banks and financial institutions said that it is urgent to bring virtual currencies into the control framework. The opportunity to break down and rebuild. About 6 months ago, Bitcoin and several digital assets hit an all-time high and the crypto economy hit a value of over $3 trillion. But by May 26, most cryptocurrencies are down from 57% to over 80% from their peak. Specifically, the crypto economy is about 56% less valuable at $1,310 billion. The strongest virtual currency is Bitcoin, BTC, from $69,000 coin, now down more than 57%. The second virtual currency, Ethereum, ETH, lost 59.85% after reaching used 4,847.57/Ether. The fourth largest crypto asset BNB is down 52.65% after touching $689 per unit. The XRP coin is even down more than 87% of its value from its peak. Cardano, ADA, hit a 9-month high of $3.10, now down 83.5%. Solana, SOL, hit a 7-month high, now down 81.5% in value. Today's 10th largest crypto asset, Dogecoin, DOGE, is down 88.8% from its high 1 year ago. At the Davos Forum, International Monetary Fund, IMF, Director Kristalina Georgieva, said, Bitcoin can be called a coin but it is not money. It is not a stable store of value because not backed by real assets. François Villeroy de Galhau, governor of the Bank of France, also agrees Bitcoin can be called a coin but it is not money. It is not a stable store of value because not backed by real assets. Acting Director of the U.S. Treasury Department's Office of Currency Control, OCC, Michael Hsu, said that the recent collapse of stablecoin Terra USD in the virtual currency market is a wake-up call and an opportunity to re-establish and recalibrate problems the industry is trying to solve. However, IMF Director Georgieva maintains that not all virtual assets are equally risky and cannot be completely abandoned. Need for global coordination. So far, there are 18,142 crypto coins, 460 crypto exchanges, and this market capitalization is around $1.3 trillion. Every 24 hours, $91 billion in cryptocurrencies are traded, most of which are Bitcoin or Ethereum. As the traditional financial system connects to the growing cryptocurrency ecosystem, the linkages are increasing, raising concerns about spillover effects that could affect the stability of the system. Global financial system. Earlier this year, the IMF released data indicating a correlation between Bitcoin and the S&P 500 stock index. However, with many data gaps existing regarding crypto assets, it is difficult to assess the impact. Comprehensive macroeconomics is still out of reach. Furthermore, the underlying technological nature of cryptocurrencies is to enable cross-border transactions without the need for any existing financial intermediaries. New applications and models such as cryptography, decentralized finance, NFTs, non-fungible tokens, and decentralized autonomous organizations challenge traditional models. This risks direct conflict with existing regulations regarding cross-border data flows, intellectual property rights, and capital controls. It can also lead to ambiguity in the tax environment, as well as raise many other policy concerns. According to the World Economic Forum, WEF, Global Futures Council on Cryptocurrencies, there is currently no coordinated international regulation of cryptocurrencies, although international organizations have been working to assess risk pricing and appropriate policy response to the rise of cryptocurrencies. Globally, central banks and regulators have been keeping an eye on this growing trend. Although they share the same goals, stabilizing the monetary system, promoting innovation and economic growth, countries from China to El Salvador have begun to consider and exercise different regulatory options. For those countries, their goals seem to fit very well: protect consumers, prevent illicit finance, protect market integrity, and promote innovation. However, Their approach is different. While some jurisdictions, such as India, have modified existing laws, others, such as Liechtenstein, have proposed their own models. Another approach, seemingly favored by the European Union and the UAE, the proposal to set up entirely new regulatory bodies to deal with the industry holistically. These territorial differences, while providing jurisdictional arbitrage opportunities, create uncertainty and increase compliance burdens for businesses operating in the sector. This is exacerbated by the lack of common standards and terminology. For a truly globally coordinated approach, countries and international organizations must work together, leverage best practices and learn from each other, assess risks and set standards. Common standards. A globally coordinated approach, including international cooperation around crypto asset regulation, will be economically optimal, protect consumers, and prevent misuse of cryptocurrencies. For illegal activities, the WEF Digital Currency Governance Association, made up of more than 80 organizations and representing different geographies, is working to achieve this goal. The association is currently focusing on examining the macroeconomic impacts of digital currencies and providing regulatory approaches, while stakeholders continue to test them for crypto management, stablecoins and currencies issued by central banks. The explosion of digital currencies like Bitcoin is one of 3 areas the authorities are currently focusing on, along with COVID and climate change. Like and subscribe our channel.